Normally in a recession, you see a private sector deleveraging and a public sector increasing their leverage, right? Because you have kind of public funds coming in to shore up unemployment and things like that, while a lot of weaker companies start going bankrupt, and bigger companies cut down on hiring and try to shore up their balance sheet. And so this cycle's been quite odd because we haven't really seen a lot of deleveraging. We've had a very compressed time frame, but we've still seen, of course, the massive explosion in public leverage. And so we've seen a sharp a rebound in a lot of asset prices, but we still going forward we still have a credit cycle playing out. So we still have many weaker companies going bankrupt or being impaired, and that's going to take probably all of 2021 to sort out. And over going back to 2016, it depends on what time frame you look at. So we saw when the dollar became strong in late 2014, early 2015, that caused kind of a slowing growth worldwide, especially in emerging markets and especially their commodities demand. And so that's where we kind of saw a pretty big pullback, especially in the natural resources sector. And then since then, when we had a weaker dollar, throughout 2017, we had a global rebound and more liquidity conditions, and but that rolled over in mid 2018, and so we re-entered a strong dollar environment. We started to get slowing global growth, declining GDP growth rates, and of course that came into a climax this year when we also got hit by the pandemic, and that kind of put the cherry on top and had a stepwise down function. I think the catalyst that I'm most heavily focusing on is commodity scarcity. And the reason for that is, it's hard to get broad inflation if commodity prices are low. And so if you look at energy prices, or industrial commodity prices, many of them are at the same price they were 10 or 15 years ago in dollar terms. And so basically, we had that period of oversupply. And so, a lot of those commodities have just been very cheap, and that's it's shown up the most in the energy sector, and we're starting to see some breakouts in some of the metals. Now, precious metals were the only ones that really kind of went against that trend, because they're generally the first to move, whereas those broader building blocks into the economy, those industrial commodities and energy, they've been very cheap. And so I think the key turning point for inflation is when you start to get, instead of oversupply, you start to get a tighter demand supply demand balance. And I think as you look out a couple years ahead, so after we have this kind of this winter period where shutdowns are happening again, and there's not exactly a ton of demand at the moment. But I think as you look out into late 2021 and in 2022, you start to get a big rebound in commodity consumption after already having pretty significant supply cuts, especially in energy. And so I think that's where you can get more inflation. And then from there, the the key risk is that unlike the 70s, the Federal Reserve won't be able to raise interest rates to keep inflation in check, and that's because sovereign debt is so high that would cause a fiscal crisis. Yeah, I think so. It can benefit both from its monetary side. So as you get a currency devaluation, silver can get a bid, and then as well as for its variety of industrial uses, a lot solar panels, electric vehicles, electronics more broadly. And so I think that's one of the metals that has a well-known kind of long-term supply demand favorable situation. Same thing with copper, same thing with uranium, same thing with a lot of these key ingredients for future as we diversify our energy mix and get more and more kind of electricity based power. So having more and more kind of a grid, stronger grids, like you need copper, and as we get kind of electrical vehicles continue to slowly take market share. I hold silver directly, so it's one of the metals you can hold in physical possession or in vaults. There's also some physical ETFs or closed-end funds that can hold it. So I like direct holding, and then as well as I do also like to have some leverage with the miners as well. And I've incorporated both ETFs and individual names. Now, because I take a pretty top-down approach, I don't go deep into individual miners too heavily. So there's a handful that I track, but there are certainly specialists in the field that cover silver miners with far more kind of individual rigor than I do. Whereas, when I go deep into companies, it tends to be in other sectors because the mining sectors, it's very specialist. I emphasize a handful of companies that have quality metrics that I like. So I like the royalty and streaming model. And then to a lesser extent, I do also go into individual miners as well. But then I also get some broad exposure with some of the ETFs just to have kind of a, kind of a broad macro-based play on the sector without taking on too much, independent company risk. But then for investors that like to go down into the weeds there, there are people that can go deep into why one company might like dramatically outperform another company. And
Mhm.
like I said, I incorporate some of that, but it's not kind of my core area of focus. Yeah, it really depends on the asset class. And so, for example, with equities, especially outside of the natural resources sector, I often use tools like fast graphs, for example, where they let you compare the stock price to the underlying fundamentals and the historical average valuation. I use Y charts for analyzing balance sheets or analyzing different types of valuation metrics. And so, when companies get notably above my valuation preferences, I begin to rotate out of them. And also, I have to define it. I have to define like another area that I want to rotate into. And so, for example, earlier this summer, I was rotating out of some of my high performing tech stocks like Adobe or Nvidia, and I was going more into the global energy plays. And so, basically rotating out of something that did very well, but that in my opinion became quite pricey, into something that recently has done very poorly, but was so bombed out in terms of valuation and it still has likely a good recovery period left to it when we look out over the next several years. So I like to rotate there, and I look at things like overbought or underbought indicators, MACD, kind of really basic technical things, just to see when momentum seems to be shifting. So for example, gold's that opportunity at the moment because I have a specific model for gold where I track the growth of the broad money supply and real interest rates. And because those are the two kind of major variables for what dictates gold price over the long term. So the very long term, gold tends to keep up with the rate of broad money supply per capita just because basically dollars being created and devalued relative to gold. You can think of it, but it tends to fluctuate in shorter increments against real interest rates. And so, because we had this summer we had some overbought conditions in precious metals, and we had a shift where real rates were declining; they were getting deeper and deeper negative, and they started to rebound a little bit because we've had an increase in some treasury yields, and so we started to get a pullback in gold and I still think the long-term, situation's favorable, but it's been under some near-term pressure. And so whenever we get these kind of pullbacks in precious metals, I'm still quite bullish when I look out with a 3 to 5 year view. And that's an example of something that even if it were to fall 10, 20%, I'm a buyer of that dip because I still think the fundamentals look pretty good. And I think that's kind of a key reason to have a process or kind of a base that you come back to see, instead of just looking at price, you're looking at price relative to certain models that you use. For companies that can include their earnings, their cash flow, their balance sheet strength, their historical valuation metrics, and whereas for commodities or precious metals, you need some other tactics, but it still ultimately comes back to fundamentals.